It's great to have everybody back. Our next speaker for the last session of this conference is somebody I've known for years, who's mentored many an entrepreneur, built his own company to $1.5 billion in real revenue, software revenue. And I'll let him tell you about that. He teaches entrepreneurship at the business school after being an entrepreneur. More importantly, he's done a lot of enterprise selling. He was a sales guy, and he probably won't have time, but he can tell you about how he sold his wife. We share that story with the business school class practically every year. But please welcome Mark, and he'll speak for himself.
Now, for those of you who haven't heard it, you someday should ask Vinod to tell you how he was accepted into Stanford Business School, because that's the other side of the same story. It's a pleasure to be here. I love Khosla Ventures. They remind me, I've been kind of in the entrepreneurial world since 1979, and this reminds me of what venture capital was all about, which was about, taking a risk, building great companies, working with great entrepreneurs. A lot of what Silicon Valley does today has kind of been, that's kind of been lost. So it's a privilege to be here. For those of you who saw my presentations in the past on the sales learning curve, this is kind of the next chapter. So let's get going over here. We have a limited amount of time. This is a presentation about leadership and a virtuous cycle in business. Or subtitle, How I Made 44 Quarters in a Row. Now, if you make 44 quarters in a row, there were no accidents there. It's not like, serendipity. It's because there's some thinking and some process behind it. So let's talk about that. First, brief Veritas. 11 years, 95,000 in the first year to 1.5 billion in the 11th year, 12 employees to 6,000, 0 to 20 billion in market cap, startup to Fortune 1000. Now, when we became a Fortune 1000 company for the first time, we were number 999, which is better than 1001. Okay, I believe there is a virtuous cycle that can be created in a business, and that virtuous cycle yields tremendous benefits and is, self-reinforcing. First of all, you want to start out by exceeding the sales expectations. And that's at the salesman level. So you want to set those goals realistically, manage the quotas in such a way that 70% of the population achieves greater than 100% or greater. There's a lot of engineers who start up companies who worry about salesmen making too much money. That is not something to worry about. What you really want to do is worry about making the company successful, and you have to pay to do that, just like you have to pay engineers these days, $180,000. You want to create a culture of success inside your company. You build an industry reputation in the world of sales success, of paying well. You attract and retain the best and the brightest in the industry. And that's kind of step one. Once you do that, you end up exceeding the revenue expectations. I'm a little behind over here. Okay. Exceed the revenue expectations. When sales overachieves, you you avoid end of quarter, end of year discounts and channel stuffing. Which is borrowing from the future, which is a bad thing to do. You can plan your manufacturing capacity in advance. You can build a backlog for next quarter. Having a backlog in business, extremely virtuous thing. Makes you extremely happy as a CEO. And avoid the temptation to take the first step down the wrong path. Every time there's a company that ends up in trouble and ethically, it's because at one point in time, at one quarter, they were this close to making it, and they decided to do something that was improper. And what you want to do is you never want to get near the edge. You want to exceed the profit expectations. Once you exceed the revenue expectations, you exceed the profit expectations. So revenue is above, and based on your plan, you're going to have excess capacity, excess cash. Manufacturing efficiency is increased. Discounts are shallower. Operating expenses are a lower percentage of the total revenue. Excess gross margin falls to the bottom line. And you can do one of two things. They can either be reinvested in the business, or you can drop it to the bottom line on a permanent basis and increase your margins. In fact, after we did a somewhat dilutive transaction and acquisition, the way we got healthy again was exactly this way. Each quarter we exceeded the number. We just dropped it, and we just kind of kept pushing up the operating margins. When you do this, you increase your stock multiples. Profit is above expectations. Growth in profit is above expectations. Greater absolute profit and greater growth give you a consistency of performance, give you higher multiples, and greater multiples yield greater stock prices for the same amount of revenue and profit. Greater stock prices is a key element of a virtuous cycle. It helps you to build the public reputation of the company, to provide shared rewards for all of your employee base, to create a culture of success across the company. Everyone wants to be in a hot company. Rapid growth in stock prices allows for smaller options for a bigger bang. So your options and your stock allocation inside the company goes further. And stock options, of course, lock down stock options, of course, lock down the best and the brightest in the company, which is, of course, their purpose. Once you do that, once you're kind of beating your numbers and you're increasing your stock price, et cetera, you get an opportunity to increase your market share. When you increase your market share, it allows you on an organic basis to invest more rapidly than competitors to take share. You can do that in the short term through distribution. You can have sales and marketing. You can spend more money and increase share that way. And you can do it in the long term organically by doing new products, new initiatives, and investing in engineering. In addition to that, these higher stock prices allow you to do inorganic or acquisitive transactions. Higher multiples allow you to buy valuable additions to your company at lower dilution to the company. All of this allows you to reduce the company's cost of capital. If you need to go to the market to raise money, higher stock prices allows you to raise money at a lower cost. It allows you to build a war chest. Note to self, and I want to try to transmit this to you as much as I can. Once you got the cash, keep the cash. Now, there's a lot of people out there who, in the investor world, will say, you know, what we really need to do is have a share buyback because you have so much cash. Not a share buyback to extinguish options, but a share buyback because, you know, it's the right thing to do for the investors. Now, those investors that tell you that story are the ones, you know, you do the share buyback, the stock pops by a couple of points. Those guys hit the sell button and they're gone. And you just have less cash, and nothing has really changed in the company. Cash is king, or I say in class, you know, cash is oxygen, and oxygen is life. And you want to keep this cash, and you never want to give it up unless you're completely bankrupt in good ideas for your company. But as long as you have good ideas for your company, keep the cash and use it. So this is this little virtuous cycle, you know. You pay the salesman more, everybody exceeds their numbers, the stock prices go up, it gets easier to hire people. End of quarter, your revenues are greater than you thought, and you kind of have this momentum going on inside the company. So the question is how do you effectuate this? How do you make this happen? What is it that you can do as a leader that can impact this? Where are we here? Okay. I have a definition of leadership. I spent many years thinking about leadership. For those of you who have companies that are in scale, the larger your company, the more time you spend thinking about what is it I'm supposed to do every day to make this thing right and to make it do what I want it to do, because it gets harder and harder as it gets bigger. So my definition of leadership is creating an environment, and that's kind of the operating word here, is you create the environment here, where you can attract the best and the brightest in the industry. They can exercise autonomy and judgment every day, which is why you hire smart people. They can do that while furthering the mission and the vision of the organization. And you can share with them a sense of accomplishment and satisfaction in the work they do over and above the financial rewards. So my belief is, as a leader, what you do every day is to create the environment that makes this happen. And that is really requires a lot of thought, and this presentation is not really about that per se. I will say that it's holistic, though. Creating this particular virtuous cycle that we talk about here, it's just a kind of a little tiny slice in that world of thinking about leadership. So this idea of how you create this virtual cycle, it all starts with the forecast that you have inside your company. I believe that it is very difficult to have an impact on the revenue line in the next 12 months. Out in time, you can affect the revenue line. You can do new products and new markets and strategic partnerships and all kinds of things. But these initiatives are measured in years and not in months and quarters. The only thing you can really do in the next 12 months are these tactical programs. They have limited effect. If you start out at the beginning of the year and you say, we think the year is X, you can make it go plus or minus 5% if you have any kind of scale, but you can't really make it go plus or minus 30%. So the first thing that's important to do is to accurately forecast. And what you really want to do is be very, very conservative, and you want to create for yourself, in terms of objectives and goals, a layup. You want to be able to say, I know what the forecast is, and now I'm going to go set my objectives and goals in such a way that I'm going to make that, and there's not going to be a miss. It's never going to happen. The forecast has to be grounded in realism. There are enormous external pressures on a CEO of a company that's successful to reach for more. These pressures come from the board of directors. They come from the employees inside the company. They come from the investors in the marketplace. Part of the problem is that internally everybody is gaming the system. I don't know how much you know about forecasting, but when you ask a salesman what do you think you're going to do, he has 12 reasons why he's not going to tell you exactly what he really thinks, right? He's worried about next year's quota. He doesn't want to be too optimistic. He doesn't want to be too pessimistic, whatever it is. I mean, so everybody is gaming the system, and you have to go forecast against this thing. It is always a temptation to be heroic. It feels good to be heroic, We're going to go out and do, $99 gazillion, we're going to go for it. And so this is part of the problem. The success in a company, it also brings the temptation to start believing that you're smart. And, that's kind of the beginning of the end of most companies, is when people stop listening to reality and start thinking they're actually smarter than that. And an indulgence in wishful thinking. So the most important thing that we can do in setting these goals and setting these forecasts is to be realistic and objective. So how do we do this? We have to determine the correct operating plan. The operating plan, everybody comes together and fights about how much money they want to spend. Because everybody wants to spend more, you have a tendency to say, let's increase the revenue line. That's a big mistake to do. What you really want to do is say, let's figure out what the revenue line is, and then give everybody their percentage thereof, their operating stack percentage of that. You want to determine the important corporate priorities. And again, you want to get back to this realistic, very, very honest number. It will most certainly be less than the sum of the individual sales quotas. Now, at Veritas, we very religiously added up the sales quotas. We subtracted 20% from that, and that became our number that we used internally. And then we used a smaller number for that externally in terms of setting external expectations. Each of the operating function expenses at a proportional share. And if we, at this point in time, just stop for a moment and do just a tiny little review of the math, if we start with a realistic number, we overassign the goals by 20%. And if you remember at the very beginning of the slide that 70% of the sales force makes their goal or better, guess what happens? You kind of blow away these numbers. And you do it over and over and over and over again. And that's kind of the process by which you kind of build this process inside the company. The problem that we all have when we want to get this real number is that the first thing we have to do is we have to negotiate with the VP of sales. Any VP of sales in the room here? No VP of sales in the room. We can talk about it behind their back. So what you want to do is you want to go to the VP of sales and you want to say, you need to give me the highest possible number that you are certain you will make. Anything less will inhibit our ability to invest in the future of the business. Now, the sales VP in your company started out as a little salesman, then he became a little manager, then he became a regional manager, then he became a VP of a region, and he went through all this other stuff. And he spent his life negotiating for quotas. He knows that his success is sandbagging his boss. He is the world's best at it, okay? And what you really need to do is you get him not to sandbag you. How do you get him to go from being, from viewing you as, an adversary in this process to being part of a trusted coterie of people whose interest is for the company? And so what you need to do is you need to build and maintain this high trust relationship. I believe that in all relationships, if you want trust, that you need to trust first. If you're a leader of a company and you want people to trust you, you have to go first. You have to break the cycle of gaming the system, which is what happens so often. You need to. So one of the things that we did, I went to our VP of sales really early on and said, "So I need you to give me this honest number, and I'm going to make a deal with you. When you give me this honest number, I'm going to go make the rest of the company stay with that number, and I am not going to come back and negotiate with you for a little more when we do the operating plan," which is what always happens. They always want to keep a little bit in their pocket, right? And so the first time I do that, he, of course, thinks I'm, a lying sack of you-know-what, and then I'm going to come back after him later on. So what I do then is I actually live by my word. I go and trust first. I go and demonstrate trust first. I take him at his word, even though I know it's not true, and we go live by that. And that's kind of painful because it's kind of a smaller number than we want to really invest at. But the next time I come to him, I can say, "Remember last year when I told you I was going to live by the number? I'm going to do it now. And now I want you to give me the real number because I want to make sure we invest enough in engineering and services and everything else so we can build a great company here. So you need to give me the real number." And then I get the real number from him. So it's really based on trust. The other thing you can do, I took my EVP of sales off of a sales plan. And I put him on the same incentive system that I work on, which was an EPS plan. How are we going to do as a performance against EPS? And you get more or less money depending on how that works. And I did that for a couple of reasons. First of all, I wanted to kind of build this trust relationship. Second of all, I really want him to make all of his sales decisions as if I was in the room, which I can't do all the time. I want him to make the decisions so that it's consistent with the right thing to do for the company. And so I kind of took him off those plans and put him on the same plan as the rest of the senior executives. And of course, I gave him a ton of stock because that's very motivating. Okay, so looking beyond sales, you create a high trust environment between the entire management team. I think the aura of trust spreads throughout the company, pervasively diminishing the gaming that goes on, from level to level and across all these conversations. You enlist the energies and talents of the population. You get a force multiplier. You get people to step up above mission of self. You can tell a company that's not in good shape when everybody is doing career planning instead of trying to do the right thing for the company. So you want them to go above the mission for self. So you do all this, and the virtuous cycle continues. And so that kind of concludes the kind of the technical part of the presentation. A couple of words to live by. I kind of always do this with my students. Regret for the things we did can be tempered with time, but regret for the things that we did not do is inconsolable. So I believe those are words to live by. You have one time to go around in life. You ought to figure out what it is that's important, and you ought to make sure that you at least try to do those things and don't have the regrets later on. And lastly, if you want a friend, buy a dog. Okay, I usually do this presentation in about 40 minutes. I did this in lightning speed here. We have about five and a half minutes or so left. Does anyone have any questions? Yes, sir.
So a lot of what you talked about relates to companies that are pretty far along. A lot of us in the room, me included, have companies that are just about to launch and are pre-sales.
Yeah.
And we've got kind of that evangelical sales problem of, not really being there yet, but needing to persuade future buyers to take you seriously.
Yeah.
Any words of wisdom there?
Yes, I actually gave presentations on this topic for many years. It's about the sales learning curve. There's a paper written. I don't know if you guys want to distribute it. It's available. I believe it's available on Amazon. It's certainly available at Harvard Business School, Harvard Business Review website. It was published there. And it talks about go-to-market in young companies and the things that you need to do during the first year, during the evangelical times, to not get yourself into trouble and to kind of focus on productivity. I can't go into the whole thing over here, but I think it's informative to the question you ask. However, I would also say keep this in your mind, because you never go, once you set the culture and once you create the kind of the ambiance of the sales organization and inside the company, it's hard to change it. And if you set it in the beginning, we say, let's let these guys make money and let's set the goals, in such a way they're achievable. It's never too soon to do that. And I think you should do that right in the beginning. Any other questions? Question in the back, yeah.
Do you have any advice on hiring great salespeople? It's always a challenge in sales leadership because they present themselves so well. It's hard to figure out who's good and who's not. And
yes, the question, that mic wasn't working. The question was, how do you hire great sales executives when you interview them, they all look so great. They dress well, they talk well, they sell to you. They're just great, right? And I have made my mistakes. I have made hiring mistakes by falling in love, right? With not just sales guys, but with other people as well. Over the years, I have come to rely much more heavily on references. So I look for resumes where people, stayed long enough to do something, and I consider that an executive level that to be, 4 years plus. A year or two, the effect is not there. And then I like to talk to people who know them in that role and say, who are these people and what are they like? I will do 10 references and I'll spend 45 minutes a piece keeping people on the phone and getting them to talk in order to learn who this person is in real life, not how they seem when you have lunch with them or a drink or something like that. So I rely very heavily on that. The other thing I rely on in hiring, either promoting internally or in hiring externally, is the people who will work for them have to look at them as someone they want to work for, and I put a lot of value on that as well. It's a great question, by the way. Any other questions?
What's the closest you've ever come to actually missing a quarter? I mean, 44 quarters, that's a long time. Lots of crazy things can happen. Financial crises, competitors. I mean, there was a lot of strategic thought probably to protect yourself from that. It's not just the sales part of the equation.
No, I've done this perfectly for all my... No, I'm not. So it's a great question. What's the closest we ever came? The closest we ever came was about 5 months before, not the end of the current quarter, but the end of the quarter beyond that. Something dramatic changed in our business outlook. We were actually this is very early in the life of Veritas. We were working on this big deal to become the key technology supplier for OS2. Thank God it didn't happen. I mean, at the time it was terrible, but thank God it didn't happen. We would have just gone down a rat hole. But we got this notification that this deal was off, and we had built it into our plan, and we had told, the investment community about it. And as soon as we got word for it, I took the numbers down. Right? I took the numbers down internally, I took them down externally, I took them down with Wall Street, and I said, these are the new numbers, and everybody said, wait a second, da 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 da, and I said, no, these are the new numbers. So when you have some notice, or even if you don't have notice, whenever something bad happens, you don't want to reach for it. What you want to do is take the expectations down. There's actually a simpler way to sum all this up. The way I tell the story in business school is like, when I leave a meeting at 5 o'clock in Silicon Valley and I'm in Sunnyvale and I'm going to go home to Portola Valley and I kind of think about, 237 and 85 and 280 and I say, well, it'll probably take me about 40 minutes, worst case, with traffic to get home. I will call my wife and say, I should be home by 6:30, right? I think I'm going to be home by 5:40 and I give myself, so no matter what time I walk in, I'm early. And that's what life is about. It's about expectations, right? If I could have told her 5:30, I could have told her 5:40, but there's some reasonable probability I'm going to miss that. Why do that, right? I said, I'll be home by 6:30. She says, great. I walk in, hey, you're early. I mean, okay, I got 4 seconds left. I want to thank you very much. I enjoyed coming here.
Last question over there.
Okay, last question.
Quick question. How many versions of you have a sales forecast, which is obviously over your plan. You have a corporate plan. How many versions do you carry? How many versions of your plan? Do you have a stretch plan,
Yeah.
a downside? I mean, what do you recommend?
So you can have as many as you like, yeah? It's up to you. We usually had 3 versions, right? We had a street version, a board version, and our own version. Okay, that was our technology that we had. The street version was the lowest, the board version was the next lowest, and that's when we had our revenues tied to, and then the real plan that we were working on was our secret, and we didn't tell anybody about that. That's a good thing to do.
And incentives for your staff is off of which of them?
Off of the board plan, okay? So we also, why not make that one a layup also? Duh. Okay, thanks a lot.
Thank you, Mark. I have to tell you one little story. At Sun, we were making all our quarters and beating all our quarters. At one board meeting, John Doerr actually brought in a sandbag and gave it to me. It was funny because I was talking to somebody that Mark was speaking, and he had made 44 quarters in a row, and the first word the guy said was sandbagging. Thank you, Mark. Thanks very much.